Good Monday morning from the Asia Pacific. Just half an hour to the opening bell in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. The euro is edging higher on Germany's election result, with the Conservative opposition party taking the most votes and the far-right AfD coming in second. We'll have the view from German companies in China and discuss what that outcome means for overall ties with Beijing.
And just ahead here on the program as well, the Trump White House is set to push Mexico to impose tariffs on Chinese imports to avoid U.S. levies.
And the Hong Kong developer New World is flagging a first-half loss of up to $875 million due to write-downs following an extended real estate slump.
Plus, we begin our special coverage of the arms race for drones and their growing role in warfare. Good Monday morning. Welcome to the show. We're looking at the downdraft across most risk assets right now. As you can see, the benchmark ex-Japan. Japan is shut today for the Emperor's birthday. Down about a fourth of 1%. We're also down as far as some of the bond prices are concerned. 2s and 10s right now, so no cash market trading over in Tokyo. If they were trading as well, going into PCE week, of course, later on Friday. Aussie 10 and Japanese 10, as you can see on your screens. Aussie 10-year yields up about 6 basis points as well. Flip the boards, please, very quickly. We'll have a closer look at this in just a moment here. In fact, that's coming up right now. Futures, some of the bond futures coming up bottom of your screens as well, and also a sense of where the curve is right now. So we're down on the 10. The 2-year should be coming up very shortly as well. Stocks 50 up a tenth of 1%. Of course, this is one we're watching very, very closely, this specific pair. As we maybe retest, we'll see to the downside some of the lows in the cycle so far. That's a 2-year German Bund there, of course, on your screens, down about 10 points right now. So just do the quick math. Slightly flatter on the curve. Right, going into the Chinese Open today, it's a different story. It has been a different story for 6 straight weeks right now. World-beating rally continued past tense on Friday. We'll see what the Monday Open looks like. 1.7%, some of the big moves we saw on Friday, certainly some of the similar names listed here in Hong Kong we'll be tracking going into the Open today. 48 straight weeks, I believe, as far as the net inflows across the Stock Connect into Hong Kong. We're very close on certain highs. On the Hang Seng Index, we're almost halfway back to the peak, all-time high. MSCI China has now in sights that October high. So we'll talk about those levels in a moment. 10-year yield, it's been a while since we had a 1.8% handle on this right now. So again, we're starting off the week and the trading day with some weakness again coming through in the CGB space. 5-year bond auction later today. Dollar China, nothing much happening there. At about 7.25, we're mixed right now going into the Monday Open here. Rebecca.
Yes, packed morning, so I'll keep this short. We'll just look at some of the big debt stories that we are watching today in terms of the agenda. To your point, we do have this 5-year bond sale coming through. We also finally, after weeks of this relentless rally in CGBs, we're finally starting to see that start to stammer and stutter a little bit. We saw the Chinese 30-year bond futures having their worst week since September, so keep an eye on that. Elsewhere, another debt story, New World Development. We had a pretty hefty chunk of losses there due to write-downs in the first half. They have this proposal essentially to pledge collateral against some of their really prized assets, and that plan is intended to essentially, instead of be a restructuring, to help pay off debt that's coming due last year, this year and next year. Just keep an eye on their bonds. They've come a little bit out of those deep distress levels. Keep an eye on the perps in particular, Dave.
Yeah, before we just talk about the big story right now, just one thing just to note right now, some breaking news. This is out of Singapore. And in case you missed it, given all the news that's come out so far, SGX, of course, and some of the measures there aimed at the stock market. So we're looking at SGX shares out of the open. We're up almost 8.5% there. So just watch it very, very closely as we go into the rest of the session here today. All right, it's busy Monday morning. Right, it's been busy throughout the weekend as well. Let's get the latest right now out of the German elections right now. Let's bring in Oliver Krok, who joins us out of Berlin. He's been burning the midnight oil there. Oliver, thanks for staying up for us here in the Asia Pacific. Just get us up to speed here where we are.
Yeah, so listen, we just got the sort of final vote. We actually get the final certification in a couple weeks. We got basically as close as we're going to get to the final numbers tonight from the vote overnight. So what we got is something that is largely in line with what the polling has been showing for several months here in Germany, which is the CDU, the sort of traditional party of Angela Merkel, now headed by Friedrich Merz, as the #1 position in Germany, coming in at 28.6%. That is a bit below the average of what we saw in the polling of about 30%. And then the other sort of great feature of this sort of election campaign that made it very unique was the far right, the Alternative for Deutschland, having a very prominent role, putting up their first ever chancellor candidate, coming in at about 21% of the vote. Where this sort of gets significant is we saw Olaf Scholz's party, the one that is currently chancellor, the SPD, they've had the worst outcome basically in the party's history, a real blow to the sort of a vote of confidence to the chancellor and the three-party coalition that could collapse back in November. But I basically spent the entire evening at the CDU headquarters trying to chat to some lawmakers to understand, as they sort of grasp this sort of mandate for this next government, what their priority is going to be. Have a listen to what Jens Spahn, one of the senior CDU lawmakers, had to tell me.
We do have a very clear mandate. Friedrich Merz will be our next chancellor in Germany. Olaf Scholz is done. And that's the good news of tonight. And we're going to change course of Germany. We will bring back growth. We will end illegal migration. We will meet our security needs, especially regarding to NATO goals. So yes, that's a clear mandate for a change of policy.
And so Friedrich Merz really sort of sets up to take over the chancellery at a time when we've had 2 consecutive years in Germany of economic contraction, potentially a third if we get sort of tariffs from the Trump administration, at a time when there is a really sort of large leadership vacuum here in Europe. And the question is, will Friedrich Merz, Chancellor Friedrich Merz, as he'll soon be known, be able to step up to take that leadership role in turning around this economy? Could he look at loosening the debt brake to get a little bit more stimulus in Germany? But more importantly, could he step up on the European stage to take on some of the issues Europe needs to face, many of which are centered right now at the White House?
Okay, Bloomberg's Oliver Crook there with the very latest, every twist and turn of the Germany election. And we'll be following more and getting more commentary on that later in the show. Allianz Global Investors will also be giving us their investment strategy. And we'll be speaking in the next hour with the German Chamber of Commerce in East China.
Yep. Now let's get to the other top story right now, also in geopolitics, also concerning the White House, with the Trump administration said to be turning up the heat on Mexico to place their own tariffs on Chinese imports as part of their efforts to avoid threatened duties out of the United States. Let's bring in Stephen Engel, our chief North Asia correspondent here in Hong Kong, about what we know so far about this latest push from the White House.
Yeah, you know, there's a lot to run through, and I'll try to do it in quick succession of events that have transpired since Friday, when we also had Scott Bessent to have a phone call with his counterpart, essentially, the Vice Premier He Lifeng. They traded barbs, saying they have serious concerns about each other's trade policies and the like. I won't get into the weeds there, but it didn't set the tone very well between U.S.-China relations for the weekend, when the Ministry of Commerce as well kind of blasted the Trump administration for weaponizing economic and trade affairs. Now, to your point and your question about Mexico, neither side has confirmed the details of a Mexican trade delegation visit to Washington, D.C. behind closed doors, but sources are telling us that Howard Lutnick, the new Commerce Secretary, as well as the nominee for the USTR, the U.S. Trade Representative's Office, as well as the economic advisor to the White House, Kevin Hassett, did meet with this Mexican delegation, telling them, not asking them, but telling them they must, or they should, apply their own tariffs on their imports of Mexican goods in order to help alleviate perhaps that 25% threat of tariffs that could take effect as soon as this Saturday. Keep in mind that 25% tariff threat that Trump has imposed on Canada and Mexico got a 1-month reprieve from February 1st to March 1st. March 1st is Saturday, so this week could be an extremely busy week of negotiations, of bargaining, of phone calls with the Mexican President Sheinbaum, as well as with Canada. China, it's a whole different ballgame as far as whether Trump and Xi will have a phone call.
Right. Steve, fantastic. Thank you so much. Stephen Engel, our chief North Asia correspondent there. And of course, in a couple of minutes, Allianz will be joining us for their take. The European stock market, by the way, has done exceptionally well. And it will be live out of Shanghai for really more on-the-ground news. Before we get to that, going into the open today, one area of weakness CGBs. As you can see, 3.5 to the upside on the short end. We're up by about 1.5 there on the long end. So the weakness is continuing across the CGB space. We're watching this very, very closely as we go into a fresh trading week. Counting down to the open of trade, Shanghai, Shenzhen, and here in Hong Kong. Good morning. You're watching The China Show. Good morning and welcome. You're watching The China Show. Welcome back to the show. Good morning and hope you're all well. So one of our top stories today, obviously, is we're looking at the developing story, certainly out of Germany and elections over the weekend. As far as markets go, it's fairly constructive, fairly clear. As far as equity futures, as you can see, the euro's bid, we do have, again, a 105 handle on the common currency. And bond futures are slightly to the downside right now. Well, let's get the thoughts on this, what this means perhaps for global equity strategy, U.S. exceptionalism. There's a China story, obviously, that's sort of been pecking away at that notion as well in the U.S. Let's bring in Virginie Maisonneuve, Global CIO for Equity at Allianz Global Investors, joining us out of Taiwan this morning. Virginie, good morning. And, well, first, thank you for taking the time to speak with us. Maybe let's start off with Europe, where that market has done exceptionally well this year so far. Just your thoughts on what's happened in Germany affects the outlook, if any, moving forward.
Yeah, thank you. So as you know, Europe was selling at a huge discount to the U.S. market, about 40% at the beginning of the year. And the U.S. exceptionalism, if you want, has led to valuations that were a little bit on the high side. So you have had a catch-up trade supported by expectations or hope, if you want, of a Ukraine-Russia peace agreement, as well as some elections, one of which would be Germany that we just had, and the other one would be in France, because those two countries were really important pillars of Europe, have had their own volatility, if you want, in the past year.
Understood. Do you think the run continues? What is it that is driving up European equities at the moment, specifically to Europe, if at all?
Yeah, I think valuations is definitely one of them, as well as those trigger points.
Okay.
I think it's very important in light of the shifting world order that we are seeing, that spending, the perspective on spending, as you know, Germany's debt to GDP is only 65% versus other countries. And I think the spending around technology and defense, as well as a potential peace dividend in Ukraine and reconstructions, have led to if you want, some hope and supported some of the catch-up in the stock markets.
Virginie, I want to shift focus to think about how China is doing, Chinese equities in this global context. And China's discount now to the world, if we exclude US, finally normalizing to this historic average. So they're trading about an 18% discount to global stocks ex-US. That compares quite favorably to the pre-pandemic trend. I'm wondering if you think that this is a trend that now holds, that we see this persisting, and in fact, is it a metric that matters?
Yeah, absolutely. So I'm actually just came from Shanghai, and I would say the tech buzz triggered by DeepSeek is definitely still there. I think on a global basis, the market is still cheap. I think people have not believed in the innovation power of China. But also it's massively underowned by foreigners. So I think you put all of this together with a very deep market that now people are discovering can be also a tech market, if you want, means that there's going to be more interest at the right valuations. If you look at the terrific 10, they've now outperformed the Max 7. If you go back to 23, and I think that's creating a lot of attention among global investors.
I want to get a sense now of whether this rally has attracted, and we're getting sort of conflicting views on this, and I wonder what you think and what you're seeing, of new funds getting allocated back to China. And I want to get a sense of whether the structural sort of long-only patient investor is participating in this current rally, Virginie.
Yeah, I think there's definitely more interest than in the past, but you still have the potential for dedicated, money to China, right? China as an asset class, the same way we view India as an asset class for many different reasons, if you want. But I do think you will see some allocation from global funds into China, particularly if it's in the tech area, developing. But of course, the discussions around tariffs, the discussions between Xi Jinping and President Trump are important factors that will potentially create some volatility. I do think that we'll have some interesting support measure for the consumer sector coming in early March, which is something that China really needs. In a stabilizing property market environment, net trade will probably not be as strong as it was last year. So the role of the consumer here is very important.
Virginie, just a quick note, because you mentioned India, which recently has seen a pullback. You don't think India will come under pressure because of the reallocation back to China? And if it's not India, for example, what other markets, if any, do you see more outflows perhaps because of this reallocation back towards China?
Yeah, I think that's really interesting. So the reallocation might be more, on a global basis from the US, where a lot of people have been very overweight. In terms of India, you've had, of course, part of that allocation, China-India. But India on its own is benefiting from several factors. One is the China Plus One strategy that many firms are having in terms of building new factories or plants in India to diversify their supply chain. As we are seeing in Vietnam, Malaysia, and other countries, right? The second thing is that although the market is not cheap, on a PE to growth basis, given the growth potential, it is still very attractive. And we are seeing a lot of innovation, a lot of new companies there that we like. And if you look at the Trump factor, if you want, India is actually quite neutral in this perspective. The final point is I do believe that India is we're going to see a lot of benefits from the demographic dividend, the same way we had this happening in China 35 years ago. So I think there's quite a few factors, and if the market comes back, it's a reason to also gain exposure to India.
Virginie, I want to pick up on one of your earlier points about the importance of the Chinese consumer in the story when it comes to Chinese equities. Other sort of so-called tech vibes that you speak about, is that changing what you think investors need to see from the MPC? And what are you expecting?
Well, so supporting measures in consumption, as you know, demographics are not in favor of China, and we have a confidence issue. People are saving, retirement, benefits are still very low on average, and I think it's about bringing that confidence back in order for the consumer to spend some of that savings. So I think if we had measures that supports, retirement income, or measures that supports, tax benefits to help people come and spend, it's not that people don't want to spend, it's because they're concerned that they need to secure their future by savings. And I think there's a clear understanding, and we've had senior leaders mentioning the consumer importance in several of the speeches in the past 6 months. And I think that's where I'd be looking for measures. Ultimately, I believe we need a pension reform in China, a big one, given the population aging. And of course, some of the funds will go of that pension, those pension plans will go increasingly into equities and to some extent into bonds.
Virginie, about 1.5 percentage points of China's 5% GDP growth last year was from net exports. Is it your assumption that if we see tariffs increase from the US on China, that Beijing will make up that shortfall with what would amount to quite hefty stimulus? Or do you think there is some amount of pain that Beijing is going to be willing to tolerate when it comes to sort of a slowing economy?
Yes, I think we'll probably get an approximate target of 5%. And the net trade contribution will probably be lower, as you mentioned, because of tariffs, and the compensation from consumer is, I think, will be the target over the period. What is really, really important is to understand where tariffs are going. As you know, so far tariffs from the US onto Chinese goods at 10% have been quite low versus the rhetoric that was given to us during the political campaign. My belief is that this is because there's a lot of discussions happening between the two countries on, if you want, reciprocal interest, particularly around the Russian issue. And so this is something that could be quite fluid, and we have to be very careful about this. But if we had tariffs up to 20%, I think the impact on net trade will not be, of course, as much as if it was 60%. And so the catch-up that's needed from the consumer will not need to be as high if we want to reach those targets. However, the principle is that we will need the consumer to step up.
Virginie, just a final question on one of the points you were just making that just round up the interview. If U.S. exceptionalism is in fact under its most credible threat yet, what happens to the market where you are, Taiwan, which has really ridden the wave of U.S. exceptionalism? I'm not going to name stocks, but we know what we're talking about here.
Yeah, so I think the concepts of digital Darwinism, so competitive forces at company, country level remains very much intact. And Taiwan is an absolute play on that. So we believe that, we're going from the plumbing of AI to the applications and the impact on productivity and transforming business models. And of course, Taiwan is critical to that. So we like Taiwan very much, and we think there's a lot of very, very good companies on a long-term basis to have in one's portfolio in Taiwan.
Virginie, thank you so much for the time. Again, as always, your insights, and have a great week ahead here in the Asia Pacific. Virginie Maisonneuve, their Global CIO Equity at Allianz Global Investors. We're going into the open today, just under 7 minutes away, going in 6 flats at the open. Plenty more ahead. This is Bloomberg. Good Monday morning, just under 4 minutes to the opening bell. We're up for 6 straight weeks on these benchmarks. Suffice to say, the Hang Seng Index, the Hang Seng China Index have been, Hang Seng Tech Index on top of those two have been your top 3, if you think about it effectively, globally last month or so. The 10-year yield on your screens were up again. So again, weakness coming through and permeating, maybe as a function of the strength that has come through in the equity market. So yeah, so 48 weeks of inflows into Hong Kong have effectively pushed up on price on the Hang Seng Index. Yep, we're almost halfway there on the benchmark itself. You see that retracement, you take it from the peak all the way to the bottom. So we're a good day away from this. The opening bell is just ahead. And yep, just a public service announcement that it's a bit cool outside. So final opportunity to needlessly show off your boots.
Good morning, welcome back. You're watching the China Show, and we are counting down to the open of markets today. About 30 seconds off, Dave, and really the market mulling all of this news we had from Trump. Looks like they're sort of getting more of these hawkish signals coming out of the Trump administration when it comes to China. But of course, we also had the German elections overnight.
Yeah, and I think on the German side of things as well, on the market side, we are seeing the euro pushing higher and futures pushing higher there. So at least as far as that part of the conversation is concerned, no disruption maybe just yet, or maybe really not. On the U.S. side of things as well, certainly the tariff conversation does present really, the higher this market goes, the more credible that threat really becomes. Because so far that hasn't really caused a lot of disruption in the equity market. So far domestic factors like tech going in, and in a few weeks, maybe out of the NPC, have so far been enough to offset some of the geopolitical concerns, although we have a really great story in the Bloomberg today, just a plug here as well, that some of the defense strategies and defense-heavy funds, are something new and back in fashion, given just the gyrations in geopolitics. Well, I guess we can table that for now. We're looking at weakness just about across the board. Onshore, it's really all about bonds today. We'll talk more about this in a moment. We're coming off really the worst week for CGBs going back to September of last year, that retracement higher in yields. Change the page, please, and it's slightly better. It sends the tone here in Hong Kong. Although, as you can see, as I speak, we're now just pushing lower as well on most of the benchmarks. They're 1.5%, so some profit taking place across the Hang Seng Tech Index and most parts of the equity market. Although we are nearing certain milestones, right? 23,000 and I think 23,900 is the peak of the Hang Seng in October 2021. MSCI China is about 76, I believe, 76 and change for the October high. But in any case, of course, it doesn't seem like we'll get there today. A couple of things we're tracking. New World was out with earnings. Innovent Bio out with some encouraging news on one of its new drugs and application being accepted. Tencent Music had a really massive move on Friday in the U.S. We're up 10% right now in Hong Kong. Why? We'll figure out why and tell you why in a moment. Xpeng is down about 1.8%. And some of the online gaming stocks, you have Tencent, we talked about this, NetEase, and also Kingsoft on some new approvals coming through. 110 and 3 imported online games. 110 domestic, you do the math, it's 113, of course, for that. All right, let's get more context on these markets.
Yeah, we'll keep digging into what we're seeing really in Chinese markets. Let's bring in our team. Bloomberg senior equities reporter Abhishek Vishnoi joining us from Singapore. And also with us in studio is Bloomberg Intelligence Chief Asia FX and Rates Strategist Stephen Chu. Maybe, Stephen, let's start with you. What is driving this bond sell-off?
Well, there are 3 main reasons. The first one is obviously PBOC has been keeping the front-end interbank liquidity tighter than usual. If you look at all the front-end cash rates, it's all about the policy rate of 1.5%. We're talking about 2% of funding rate every day. So from a leverage perspective, that actually sort of forced the bondholders to sell because they're not making any profit. And of course, the PBOC is not cutting rate. They are not cutting the triple R, and market has been disappointed. So that's why you can see sort of like a retreat in the bond yields. That's the first reason. So secondly, it's more kind of external, because we know the DeepSeek development, the rise in the DeepSeek, the rise in the equity market. So everybody's talking about equities. That's why we are pretty free these days. So you can see that the goodwill in Chinese equities, in the Chinese economy, because of the AI prospect going forward, actually helps the back-end yields to rise. So that sort of helped bond to sort of sell off again. And last but not least, of course, we have the March 2 session coming up, and China is going to announce the new supply for the CGBs, whether it's general bonds or special bonds. It's going to be huge. Now, market is expecting a record year of bond supply. So 3 trillion yuan of special bonds and over 5 trillion yuan of general bonds. That's going to be massive. And yields basically sell off.
Right. So everything from supply to technicals to maybe fundamentals are pushing yields higher. Can it continue short term?
I think the near term for sure. And the PBOC is super happy about it because we talk about record low 10-year yields, especially almost every session last year. And now we're seeing yields rebound, and they're happily to have that right to continue. Especially from a valuation perspective, I think yields might still be too low. Look at the 10-year. It's still below 1.8. And according to our model, at least it's going to be closer to 2%. So we think there's still more headroom for yields to rebound from here.
Okay, that's the fixed income side of the conversation. Abhishek is with us out of Singapore with the equity part of the conversation here. Yeah, Abhishek, you guys have a piece out right now. Just give us some context on the moves we've seen in recent weeks. What does this mean for EM, and really what China means for EM too?
Well, it's actually the rest of the EMs taking China's lead. China has outperformed by such huge amounts, versus the US, that rest of the EMs are also looking to do a catch-up. So there are budding signs of some money coming in. There are budding signs of some, funds re-looking at fundamentals of emerging markets, excluding China, in the face of possibly, some signs of dollar weakness and Trump moving slower and in smaller increments on tariffs and other policies. There's definitely an undertone of uncertainty, but I think markets have gotten used to it. Our reporting has reflected that emerging markets, excluding China, would also now play a catch-up to how China has been doing. But obviously, it won't be as big as what China has done because of DeepSeek and a couple of other things. But this is a very trading sort of setup, David. It's not a structural move on emerging markets, excluding China, like what we have seen in China so far. That's because, there are two key events that are on the horizon. First is obviously the March 5th, 2 session, what comes out of it, what markets make of it. And then the most important bit would be what Trump does when he gets armed with those, trade review reports come in early April. That's the major pivot, and that's what we would be, one would be reassessing how the investment landscape would change, what kind of moves Trump is planning, on China and other markets. And that's where, this thesis sort of would dilute a bit.
Abhishek, I want to ask also about all of the Trump news that came through the weekend. Some commentary that perhaps this is even more damaging or more wide-ranging in its impact than the initial 10% tariff number that came through. To what extent are we seeing markets react to that today? And, in terms of that momentum that investors have from the sort of tech DeepSeek rally, does it really feel like it has legs when you're speaking to investors?
Yeah, the second part definitely has legs. It does have legs. That's what our reporting is reflecting. And the first part of your question, where you're talking about what Trump has said over the weekends, there are 3-4 stories running. The views are mixed. A colleague of mine got views from a buy-side strategist at UBS. They were not that optimistic about it. But I was talking to another senior macro strategist, on a fund side. That guy was saying that, it's largely priced in. It does add a tone of negativity around China, but the triggers that are coming out of China, especially in terms of technological advancements, possibly more stimulus, budding signs of a consumer actually looking to spend more or channelize its savings into productive use, in the market. All those things do point out that China would have legs. There might be a breather. There definitely will be a breather because the markets have rallied so much. It's a marathon, so there would be a breather, but it won't change the trajectory that we are seeing in Chinese stocks right now.
Yeah, well, let's hope you're right. For the massive group of investors that have waited, 2-3 years for this. Abhishek Vishnoi, thank you, our senior equities reporter in Singapore for us, and here on set in Hong Kong, Stephen Chu, our chief Asia FX and rate strategist at Bloomberg Intelligence. Right, let's talk about earnings. So New World Development was out on Friday, and they come up with a number right now, up to $875 million in the first half as far as the loss is concerned for that specific period. That's because of some write-downs here. Patrick Wong, our Bloomberg Intelligence senior analyst, is here with us to talk us through this. So we now have this range of what that loss looks like for New World. We know it's a write-down story. Are they in a worse place right now, or is this something that we were expecting anyway?
Yeah, I think the challenge right now is that for New World, right, everyone knows they have problem. And then basically, I think the profit warning here this time is also mentioned about the write-down of the development profit, right? Basically, the projects they have like in Kai-Tak or even some Chinese projects, I think is getting challenged, right? And then another issue I think is about the investment properties they have, because like office prices definitely, I think, is falling down quite a lot in Hong Kong and also mainland China, major cities. So that's why they also lead them right down as well. So basically, I think now the challenge for New World happening is on the leverage ratio, that we could see the further increase in leverage ratio. They didn't mention it in the profit warning, but basically, I think upcoming the 5-day with the results, we will know more details.
What's the biggest impact when we have the profit warning? Because obviously there's been some optimism when we look at the reaction from bonds that we're not going to see a restructuring, we're going to instead see sort of a refinancing plan that's going to take place with lots of sort of collateral being pledged. Yeah,
exactly. I think now the concern for lots of people or New World is basically on the pledging lots of assets for the refinancing of the bank loan, which potentially could be buying time for them, right, to potentially, if the market pick up further later, right, Hong Kong, mainland China, we'll see how it goes. But basically, I think New World need to buy time, like 1 or 2 years, and then to make sure that they have to be okay for the next couple of years as well, right? So basically the challenge right now, I think, is when we see the profit warning this time, the leverage ratio is hitting like maybe even like 100%, that kind of thing. That may be a potential risk for lots of concern for investors. So, but we'll see how it goes, right?
Yeah, I mean, the equity story is the easiest to talk about, but I think this is really more a credit story. And, you know, Rebecca, you and I were talking during, as we were preparing for the shows, right? And we had to look really at the sort of risk curve of some of the credit that New World is trading at. I mean, we're closer to a name like Vancoff, for example, than we are where I think if you had to ask New World themselves, they wouldn't be putting themselves in that basket.
Sure. Definitely not.
Definitely not, right? And the news that right now, I think shares of Vancoff are actually up. Can we show that, please? 5%, if not just under that as well, on this loan support coming through from Friday. And I think the question that I have, I'll tie those two things together for you, Patrick. Can New World look to developments in the mainland on the fundamental business, new sales, for example, to help alleviate some of its financial pressures?
Yeah, I think definitely. The thing is, what we see is the pickup for the Chinese property, right? So happening, right? Recently, we also see some state-owned developers, they also buying land more actively, right, to support the market. So we see they're willing to pay some extra premium to buy land, so which is a good sign, right? Of course, it also takes some time to see how it goes because I think it's more focusing on the major cities, right? But for New World, they have some Greater Bay Area projects, so that is also having a pretty good momentum in terms of sales.
Yeah, just very quickly, I think that's a key point. The story out that Chinese developers are now starting to buy land at a premium. How important is that story? Why is that relevant?
I think that is also showing the signal that some of them, they can really sell some of the projects, some of the units, so that's why they have money to buy, right? And I think the support from the government is very important for the bank side as well, so they have the extra funding to do it. Of course, it's also confined to some major names, major developers, but I think it's at least sending some good signal to see how it goes in later of this year.
Yeah, one of these sort of positive signals that we're finally starting to see emerge when it comes to Chinese property. Bloomberg's Patrick Wong joining us there. And coming up, Ukraine's Volodymyr Zelenskiy says he's willing to trade his presidency for peace and NATO membership. We'll have the details on that story next.
Plus, a look into the global ecosystem of drone production that's really putting unmanned aerial vehicles at the forefront of the world's battlefields. A special report is just ahead. This is Bloomberg.
Ukraine's President Volodymyr Zelensky says he's ready to step down as president if peace is guaranteed. Just take a listen.
To achieve peace, if you really need me to give up my post, I'm ready. I can trade it for NATO membership if there are such conditions. I am focused on Ukraine's security today, not in 20 years. I am not going to be in power for decades.
For more, let's bring in Bloomberg senior editor Derek Warbank. Derek, context is everything. Why is this becoming such a hot-button topic for Ukraine, but also Russia and Trump?
Well, Rebecca, thanks so much. Volodymyr Zelenskyy's status has been a talking point, particularly with President Donald Trump. He and Zelenskyy have had a bit of a falling out over the last couple of weeks, and one of the key things that Trump has been talking about is the possibility of elections in Ukraine. Now, this is something that Russia has been pushing for a while, for reasons you can sort of fill in the blanks on. But Trump has said that Zelenskyy has low poll numbers, even though Zelensky's are higher than perhaps Trump has said. They are certainly lower than when the invasion started. Zelenskyy here is making a sort of a fine point. There is not a prospect for Ukraine having NATO membership in the imminent sort of thing. So if he's discussing an offer to do one for another, that's not really an offer that's on the table. But he is signaling that he's willing to talk about a Ukraine where he is not the person who is the head of it. What Zelenskyy is trying to do overall, though, is find ways to set up Ukraine in a Trump administration with explicit U.S. security guarantees. What he's talking about there is not just economic guarantees, but military guarantees. This comes as the U.S. and Ukraine are trying to come to terms on an economic security deal that was put forward. The mineral rights has been a key point of contention there, but the Ukrainians are looking for much more from the Americans in terms of guaranteeing their security. There are going to be any number of conversations going on in the next weeks to months between the U.S. and Russian sides on a contours of what could be a Ukraine-Russia peace deal. Land is going to be important there. Economy is going to be important there. I think top of mind for Ukraine officials right now, though, is how do we make sure that if the shots and the bombs stop, that they don't come back a couple years hence, as they feel that they saw between the pause after Russia's first invasion when they took Crimea and the next invasion where they went full on in.
Derek Wellbank in Singapore First, our senior editor. Now, speaking of the battlefield and warfare, this week we'll have some special coverage into the arms race for drones, specifically. It's a competition really that involves the U.S., its allies, and also China. Our tech reporter, Annabelle Jewelers, explains how drones are really set to play an even bigger role when it comes to warfare.
There's no question that drones have altered the dynamics of military operations. Unmanned aerial vehicles, or UAVs, have been in use for decades, including in the Cold War, Vietnam, and by the US to strike remote targets after 9/11. But on today's battlefields, it's different, not least because of the sheer volume of UAVs in the skies.
The current war in Ukraine is very much a drone war already.
The situation has been mirrored in the Middle East, with Hamas and Israeli forces deploying UAVs extensively. It's a signal of what's ahead, with the US spending hundreds of millions of dollars to secure new drones through its so-called replicator program.
If there's a major power war, it's very much going to be a drone war.
Technology is moving fast, particularly as artificial intelligence is integrated into UAVs.
Air superiority in a future conflict is not just going to be about fighter jets. It's going to be about drone swarms and loitering munitions and AI-powered targeting systems.
There's also a question of quantity, as military forces need to procure large numbers of less advanced drones. This has been a weak spot for the US and its allies.
US and many European states, they've actually for a long time been investing a lot more in the sort of more sophisticated long-range drones that have lots of sensors to them. It's really the mid and lower end stuff that they're trying to build up numbers, because as we've learned from the Russian-Ukraine conflict, the numbers do matter.
But China is the leader in commercial drone production, with its firm supplying around 80% of the global consumer UAV market. And Beijing has long seen these as a dual-use technology.
They've been real pioneers in cheap commercial drones, which can be adapted for military use.
It's clear that this is an area where China is putting intense capital, but also policy focus. I think the Chinese recognized quite early that drones could be the difference between victory and defeat.
Now Beijing's rivals are racing to catch up.
Annabelle joins us now from Hong Kong. We've just heard how China is dominating the UAV end sales, at least. How else are we seeing its influence ripple through this industry?
Yeah, I think the biggest influence that we see as a result of that is also just going back to the supply chain and really who has such a dominance in that. And it's well and truly China, and we see how that can kind of be weaponized in any sort of military situation. And so that is the real challenge for the US and its allies now, that need to be able to develop drones that essentially don't have any components that are made in China. I think this research that was published last year in the MIT Technology Review also puts it into sharp focus. Here they're breaking down the components of the FPV drone system. FPV is essentially first-person view. This is a type of drone that's been used extensively in Ukraine. It puts the drone pilot sort of in the cockpit, but through wearing goggles or some sort of video feed. And so you can see, just looking at 6 of those, although they have a lot more components, but you can see how the tech has originated in the US, also in allied places, Russia, of course. But today, the main picture is that it's produced in China. So China is able to produce really all drone components at scale for low cost. They've obviously added in their own manufacturing expertise. And so extricating yourself away from this supply chain is really challenging. And that's really what we're seeing now that the US is trying to do. We're also going to be going to Taiwan this week to talk with different drone companies, government officials there to really understand what push Taiwan is making, again, to completely move its production away from China and to develop those key relationships with the US, allied countries. Baltic states, for instance, we're already seeing government-to-government agreements now. They, of course, Russia have seen what's happened in Ukraine. But it's going to be quite a big challenge for Taiwan and also for other places.
Yeah, and certainly we're going to be staying tuned, of course, to Bell and the team's coverage out of Taiwan this week. Stay tuned for that coming through here on Bloomberg TV. Right, later on the show, we were discussing also China's defense strategy amid the flare-ups taking place across the South China Sea and beyond. We're speaking with retired PLA senior Colonel Zhou, now a senior fellow at Tsinghua University Center for International Security and also strategy. Now, as we head into the break, a glance at the Hang Seng Index, which has now shaken off the early cobwebs. We'll tell you why in a moment. This is Bloomberg. Right, welcome back. You're watching the China Show. Okay, so we thought it was going to be a quiet session. So last few minutes or so, Yitai reporting that Alibaba will be investing 380 billion. That's billion. That's not US dollars rather. That's renminbi into AI over the next couple of years or so. So you simply do the math into US dollar. That takes you to about roughly 50 billion US dollars. Just for context, Alibaba is sitting on about 110 billion of cash. Not that we're saying they're going to be tapping all of that as well, but certainly gives you a sense of the scale that they're willing to invest into this. And the market's listening, in fact. Markets, Alibaba, and the benchmark opened lower, and as you can see, we now have a green color on our graphics today. Plenty more ahead on this. We're coming off a 6-week run, and it looks like we are just getting off on the right foot this Monday morning. This is Bloomberg. Welcome back. We're just entering the 30th minute mark of the cash market, the second hour of the China Show. Welcome to the program. So we started things off on a fairly quiet note, let's put it that way, and then of course we had the big news out of Europe. We'll talk more about that later. Plus, of course, the latest in the Trump story and the Trump news and tariffs and Mexico being involved. Something to talk about these last few minutes or so, this report out of Yitai and Alibaba. Maybe they're giving a number here on what they plan to do with the technology.
Yeah, 380 billion yuan there on spending on AI. We've talked a lot about, the AI story offsetting some of these tariff risks that we see, and it's really precisely around this, the amount of money that we're going to see being funneled into AI off the back of this, the whole question of capex spend, of course. Yeah, unfortunately, that Yitai report is literally 2.5 lines, so we don't really have a lot more details. A little short on the detail there. Markets listen, though. Initially pushing the markets up. We're just coming off highs a little bit, as you can see on your screens. Now, that said, the other stories we're tracking here today, the other strands to the Chinese market story this week. So we had an index review on Friday into the close, and I don't need to tell you which stocks were added to specific benchmarks, but I think certainly from the price action you see on your screens, there were some changes effective in a couple of weeks. Tencent Music, Horizon Robotics added, and of course you have a removal as far as East Buy and Zhong Insurance are concerned. Right, now back to the geopolitical story. Wow, lots to talk about here. So some shipping stocks are actually down on these proposals around these shipping fees out of the White House. So Costco shipping is perhaps the poster child for this currently. Not a lot as far as the other names are concerned. The other story that has unsurprisingly caught the eye of many people and the attention here is you have some of these vaccine and test kit maker
stocks, not just in China. We did see a move up in the U.S. session on Friday across the region in South Korea. Japan is close, by the way. Because of this, news that researchers at the Wuhan Institute, the Chinese lab, of course, in Wuhan had discovered this COVID-like bat virus. It's worth noting that the virus has yet to be seen in humans yet, just to downplay that bit for the moment. You can read all about this, by the way. But in any case, of course, we are seeing markets react to this story. Currently, we'll see what this. We'll keep on top of the story, of course, as we move.
Yeah,
forward
sort of
as well.
a story that no one wants to read.
No.
Everyone has an eye on.
Flashbacks. Yeah.
The other thing we're watching for is Asian central banks. It's a really big week for them coming up. We have decisions out of the Bank of Korea, the Bank of Thailand, but really the focus for markets is going to be on those US GDP numbers that come through on Thursday. And of course, we have the release of PCE data. Now, that's really the preferred gauge for the Fed when it comes to inflation.
Absolutely. So can we trust the pricing around the sort of Fed's, the number of cuts? Well, I'm now cognizant, I just used plural there for cuts. Number of cut priced, that makes any sense. And of course, the other one is the NVIDIA set of results, which I believe are coming out midweek as well. So on the AI story, but again, on the U.S. exceptionalism side to the conversation. Mark Cranfield joins us right now to talk us through what his top thoughts right now are as we just get underway. Mid-morning, Mark. Yeah, so far, what's caught your eye across markets this morning?
Well, the Alibaba headline is pretty impressive. That's a decent amount of money. If that's true that they're going to invest in that kind of money, markets surely will like that. I mean, already the AI narrative in China is building up pretty nicely. So you just throw a bit more onto the fire there, and you certainly will stoke up people to get involved there. It's an interesting situation here because we've spoken about decoupling before over the past 5 or 6 years or so. There have been various times when people thought, well, maybe Asian markets, China in particular, could decouple positively from the US and the rest of the world. And it never really happened. We just found out that whatever direction US markets go, the rest of the world tends to follow. It is potentially we're actually going to get something more serious this time because China has its own AI story, which is really just beginning and looks as though, if you look, there's a report today that some Chinese government-related companies are already adopting DeepSeek-related products into their work as it stands. Plus, there's obviously going to be more following as well. So there is actually potential that this finally Chinese tech stocks actually may be able to go in a better direction than their US peers. So if the story is becoming a bit tired, if the so-called Magnificent Seven in America has done as best they can, maybe China really can pick up the theme here and actually drive its markets in a direction regardless of what happens in the US and the rest of the world. So certainly when you've got a huge company like Alibaba spinning a very positive outlook for the AI story in China, maybe the decoupling really will happen. And this year, we'll see a big outperformance by Chinese stocks related to the US.
Mark, just shifting gears a little bit, I want to ask about Germany and what kind of read-through we are seeing from markets there, from the results of the election. And I suppose the importance, the significance of how quickly we see a coalition coming together, because presumably part of the reaction is going to depend on the pace at which that happens.
Yeah, I think that's exactly what you're seeing with the euro exchange rate. The euro's having a pretty good morning. It's already the best performing G10 currency. And that's mostly relief. Traders are happy to see that there seems to be a pretty good chance that Germany can form a government fairly quickly. And I think that was the thing that was holding back the euro going into the elections. There was fear among some investors that the result from the elections would be such a mess that it'd be very difficult for anybody to get a government going quickly. We might get a long period where Germany is trying to do it, nothing happens, and you get a big policy drift, a vacuum, while you don't have any leadership. That doesn't appear to be the case. It looks as though the results that came out of the weekend are close enough to expectations. It's a relatively clear situation, even though there's no party that got 50%, but it does look as though it's good enough to be able to get a government together fairly quickly. That's what the markets like about this. They're not so concerned whether it was the left or the right who won. What they want is a clear German government with a mandate to get Germany back on its feet. That looks as though it has potential, and that's why the euro is performing quite well today.
Mark, two other items, major items on the agenda this week. Midweek is NVIDIA earnings, and then you have the Fed's preferred gauge of inflation going into the weekend. Which of the two you think will be more consequential this week?
NVIDIA is always very important, particularly given what's happened with the Chinese-related AI story. So definitely they have the ability to move the markets. People will be very much looking at their outlook, whether it's sustainable, whether they're going to be able to keep on producing the kind of results that they have been. And then certainly you mustn't underestimate the Fed situation with inflation. Clearly, the Fed have expressed themselves, they're concerned the fact that there's a change of administration in the United States. The policies coming out could be inflationary as the year progresses, and this will certainly be one of the early indicators to see what's happening in that direction. Bloomberg Economics seem to think it'll actually be a soft number, but that could be because we haven't seen enough of the policies in place yet. But whatever happens, both events are able to cause plenty of short-term market volatility. So it looks we're in for a pretty exciting week, whichever way it plays out.
Okay. Bloomberg's Mark Cranfield. I'm sure we'll be talking to you later this week. Coming up, we also have the German Chamber of Commerce in East China. They're joining us to give their outlook for businesses in China. That interview is coming up next, so stay with us. This is Bloomberg.
We ran a very tough election campaign. Nevertheless, this election campaign was really necessary. Also in the debate about the important and major issues of our country, about economic policy, migration, foreign and security policy, and internal security. But now we will talk to each other, and the most important thing is to reestablish a viable government in Germany as quickly as possible.
Germany's Conservative opposition leader Friedrich Merz there after his bloc was projected to win Sunday's federal election. And we're just seeing some reactions coming in China to the results of that election, with state media striking a positive note so far. China Daily says Beijing is committed to promoting the healthy development of China-Germany ties, regardless of which party secures victory. It says the relationship is of strategic significance to both countries and the rest of the world, while pledging that China's Germany policy remains unchanged.
Now, the paper adds that China appreciates Germany's rational and pragmatic stance on the EU's tariffs on Chinese EVs, while expressing hope that, well, Berlin will continue to play a role in resolving many of these tensions, obviously affecting trade ties that basically span across a multitude of industries. Let's talk more about the potential implications of what's come out over the weekend out of Berlin and what it means for Beijing's ties, and certainly German companies on the ground in mainland China. Joining us now is Maximilian Butek, Executive Director at the German Chamber of Commerce in East China. He joins us out of our Shanghai studios. Maximilian, good morning, and again, thank you for taking the time to speak with us. So I guess the obvious question is, how do these events in Berlin affect your companies under your watch, for example, you know, a 9-hour flight from Beijing to Berlin and half across the world?
Good morning. Thank you for having me. I think now it's really important that the government rethinks its Chinese strategy and how to re-engage with China, because there are so many domestic challenges in Germany and the EU, and also the challenges arising with the transatlantic relations, which probably are not as they were before. So our companies here really hope that the new government will form very quickly and then re-engage with China.
We have had some critical commentary from about China so far. I mean, how are the businesses that you represent, the investors that you're speaking to, what is their sort of sentiment and response to the election results that we are at least seeing projected coming through?
You know, also the German companies have challenges in China currently, obviously. I mean, the domestic market is not as strong as it was before. The investment confidence is not very well in China. But also imports our companies are getting from Germany are getting less competitive because of the high energy prices, but also the cost of operations we are having in Germany. So our companies really believe that the new government need to focus on the first hand, on the competitiveness on Germany, but also gets into a better discussion now with China. You know, you mentioned it also in your show earlier. We have these tariffs still on EVs, which at least cause tensions. So we hope that those tensions can be rather transferred into an open dialogue, how we can tackle the challenges we are having in our relations, but also how we can enable our opportunities we have. I mean, Germany cannot be competitive globally if they are not invested further in China.
Yeah, if you could talk, maybe just tie what's going on as far as the geopolitical front is concerned to this new report that you guys put out, Localization 3.0, because I think this goes really into the crux of what you're mentioning, that German companies can only be competitive if they're able to bring some of the R&D, for example, into China. Just tie those two things for us.
Yeah, so first of all, it's quite remarkable that German companies in China get to feel what geopolitical tensions are, because in the past German companies did their business not focusing so much on geopolitical tensions, but with those tensions coming not only from Washington but also from Brussels back then, it really forced companies to rethink their engagement in China and to make it more robust, right? So while they are while they're focusing on diversification, so means having value chains outside of China to serve the US and the European market, they also understood how important it is to remain competitive in China, and this they only can do if they build their supply chain here. And this now, that's why we called it Localization 3.0 or 3.0, because it's not only about production in China, it's also about investing heavily in research and development to, on the one hand, serve the local market better, Chinese consumers, but also to not miss out on this innovation ecosystem companies find here in China. So if you look what happened with DeepSeek in February, so it really showed that China is highly competitive in the high-tech sector, and German companies have to invest here to participate in this ecosystem.
Maximilian, we've seen the sort of exodus of foreign firms from China seem to be bottoming out, even if overall investment is still really sort of plunging. German firms might be the exception, German investment might be the exception to that in the first half, at least, of last year. For the German firms that are staying in China, how are they thinking about the risks of being caught in the crosshairs of the US and China relationship? Because, of course, it's not just a question of, for example, EV and trade tensions between China and the EU.
No, you're absolutely right. And of course, the questions German companies have is software they develop in China still to be implemented in the US, right? And can they use technology they develop in the US, still continue to import in China and use here? And at the moment, it looks like that this might be challenging. And we don't like to talk about decoupling, but this is definitely a scenario we have to look at. So German companies try to see ways how they can mitigate these risks. Nevertheless, it's also proven that German companies invest further because they see the Chinese market still as very relevant, and they see their own competitiveness here given, while other companies from other countries might not see the future in this regard.
Can I just also ask you about, since the presence is still, let's put it that, increasing, if not remaining the same, in the domestic market. I want to ask you what you're seeing as far as demand is concerned for final goods in mainland China, because we hear a lot from companies talk about how competition is still fierce. You're still getting some price pressures across most, not all sectors. What are your members telling you?
Yeah, so of course the sentiment is in the short term rather negative, right? Because this lack on domestic demand led to such a fierce competition and a price war where it's super hard for any company to make profits. On the other hand, a lot of companies also telling me that they see this as a chance as they expect a consolidation to be happen in the future, and they are quite sure that they can survive this consolidation and then come even out stronger. And by being forced here to become more efficient, to increase productivity, to lower the costs, this will make also German companies more competitive on the global market. So the sentiment on the short term is quite negative and cautious, but on the medium and long term it's rather positive.
Maximilian, what message is it that you are taking on behalf of your members to Chinese officials, to Chinese policymakers, and how receptive do you find they are to those proposals?
Yeah, you know, for us, it's quite understandable that the Chinese government protected the market in order to industrialize their own economy. That's all clear. But now, while Chinese companies became so strong and competition became so strong, we believe there is no need to protect the local companies anymore. So level playing field will be so crucial for German companies to invest further. And we also believe, if you look at the transition the Chinese economy does from low labor cost, low tech to high tech, they also need German companies, right? And the Chinese government signaled us they really understand, and they are asking us what can they do to support our companies. Nevertheless, we expect also more actions in the policy area, especially when it comes to fair competition, to access to local tenders, to domestic tenders, etc., so that German companies can further grow here in the market.
Right, Maximilian, just a final question, because you mentioned something there, that they're asking you what they can do to make life better for you guys. So what is the answer to that question?
Yeah, the question is they have to include us better into the local market, right? If there are public tenders, they need to involve us. Of course, we need the same subsidies as Chinese companies. We need same access to credit, and we also need the same access to universities, for example.
Okay, Maximilian, thank you so much for sharing those insights this morning. That's Maximilian Butek, German Chamber of Commerce in East China. We'll have more analysis of the German elections and, of course, what it means for China still ahead. We'll also be hearing from the Peterson Institute for International Economics why they think that the conservative opposition leader, Friedrich Merz, did not win the election in the way he would have wanted. Stay with us. You're watching The China Show. This is Bloomberg. Good morning, you're watching The China Show. Here are some of the top corporate stories that we are following today. At least 3 of ByteDance's major investors have marked up the TikTok owner's valuation to over $400 billion. Sources say SoftBank's Vision Fund reevaluated the firm in December, factoring in potential for its AI business. Fidelity Investments and T. Rowe Price have also marked up ByteDance. It's a sharp rebound for the firm that's been threatened with a US shutdown. Fast fashion retailer Shein's profits reportedly slumped by almost 40% last year. According to the Financial Times, the retailer's net income slipped to $1 billion, even as sales jumped 19%. A source told the newspaper the figures were internal projections before accounts are finalized. Shein confidentially filed for a London IPO back in June and is said to be under pressure to cut its valuation to $30 billion. Berkshire Hathaway's operating earnings surged 71% in the fourth quarter, driven by higher interest rates and a recovery in its insurance underwriting business. Meanwhile, the firm's cash hoard grew for the 10th quarter in a row to a record $334 billion at the end of 2024. Warren Buffett also expects pre-tax losses of approximately $1.3 billion from the recent LA wildfires.
Yeah, well, a part of the earnings report and the annual letter, of course, which a lot of people look forward to, is really what they say about where the company is looking to then increase their exposure, right? So what the Oracle of Omaha buys, that's typically a good indicator of what the stock price. Not all the time, but certainly it's happened in Japan, for example.
Yes, exactly. And so he is saying that his company is likely going to increase ownership of Japan's 5 largest trading houses over time.
Gradually.
Yeah.
And I think the first time that the chart effectively shows you back in August of 2020 when news was first made public that they were looking to do this. Since then, of course, names like Marubeni, Mitsubishi, Sumitomo, I think Itochu is the other one, which, by the way, have taken a backseat as far as some of the global footprint of investors in Japan is concerned, are now back in the spotlight. So the topic is up quite substantially since that point in time.
Yeah, I'll just add, this is the response. So Berkshire initially intended to keep its stake below the 10% threshold. The 5 companies have agreed to, this is a quote, moderately relax the ceiling.
I wonder what that means. Yeah. Probably getting a bad massage. I'm moderate relaxed after that session. Okay. Japan is shut, by the way, today. It's the emperor's birthday. The other stories we're tracking here across the region, let's start things off now with a pivot to Singapore and Hong Kong. 2 things. You have the listed shares on your screens of the exchanges themselves. SGX, this report, this announcement coming out of Singapore that this plan to boost local equities by investing 5 billion Sing with fund managers to then maybe lift the stock market, lifting the stock. HKX is down 350 a pop. Morgan Stanley has a price target of 450. Do the math, and that's the implied change. Speaking of, by the way, Morgan Stanley also raising Alibaba ADRs to overweight as well, just in case you missed that. Okay, Shenhua reporting maybe a little bit more policy support as it pertains to recycling and reuse and as far as the EV vehicle battery is concerned, some of the names there on your screens are bid up. CATL, of course, is going the opposite way. And China Vanke, this is the report out on Friday, I believe, with, I guess, more credit support here for the company.
Yeah, absolutely. Really closely watched for the level of state support that it's going to receive. But it does look like it's sort of an exception to the rule here when it comes to Beijing and the state offering to step in to support a Chinese developer.
Yeah. The broader story there, we just want to call your attention to the other story, which is Chinese developers are now starting to buy land at a premium. More of them are doing that, which I guess is indicative of more of these early green shoots we're seeing in the housing market on the mainland. Welcome back. You're watching the China Show, the benchmarks on your right. So we've been bobbing around between gains and losses. We've been mostly positive in the last 30 minutes or so. The 30 minutes before that, the jury was out until the Alibaba news came out, which they then confirmed that they were investing quite a hefty amount, or they will be investing quite a hefty amount into AI these next few years or so. I believe the figure is at 53 billion. That's US dollars. So we are off to a decent start to what possibly could be a 7th week of gains for Chinese equity markets against a backdrop of really everything else that has sort of paled in comparison to what's happened here. Japan is closed, by the way, today, so just a glance at Asia ex Japan, we're down about a 51%. S&P futures, it's important to note we're coming off quite a big drop on Friday, and this bounce we're getting off the 50-day moving average on E-mini futures is perhaps, I guess, indicative of what the session might look like going into later on Monday.
Yeah. And back to one of our top stories, I mean, and really, in fact, sort of linked to this theme of how markets are reacting to the trade news, and it seems in China very much overtaken by the Alibaba news. But going back to some of those geopolitical stories, we did have U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng exchanging complaints over tariffs and Beijing's economic model in their first discussion since the Trump administration took office. We've also learned that Washington is putting pressure on Mexico to slap tariffs on Chinese imports.
Now, last week, the White House released its America First investment policy, which labeled China an adversary. Now, the report accuses Beijing of exploiting American investors to advance the development of its military.
Yeah, and another potential flashpoint between Beijing and Washington, of course, is Europe and the role that China could play in a possible ceasefire in Ukraine. Joining us now is retired senior colonel of China's People's Liberation Army, Zhou. He's currently a senior fellow at Tsinghua University Center for International Security and Strategy. I want to ask about some of these specifics of the role that China can play as a potential peacemaker when it comes to Moscow's war in and with Ukraine. Do you think Beijing sees itself as a possible guarantor for European security?
Definitely, Rebecca. Actually, I believe China can play 3 roles in this war. The first is one of the guarantors, along with other major powers, if a ceasefire is in place. Why is that? Because the Ukrainians deeply remember the pledges of the 5 nuclear powers when they decide to relinquish nuclear weapons. To some extent, of course, that kind of guarantee was not very much substantive in that all the 5 major powers could not provide a so-called positive guarantee. That is, if somebody beats you, then I will beat him. But this is what they remember. Given the volatility of the situation, I believe Ukraine will be afraid if there is no guarantee from major powers. Actually, this is what President Zelenskyy had been talking about. And on the other side, Russia also needs a kind of security guarantee. Why? Because Russia doesn't want to stand looking isolated, right? Because the whole West is behind Ukraine. Then who might be on Russia's side? China is not on Russia's side, but President Putin talked about how China, India, and Brazil, these countries from global south, can be honest brokers. This is the first thing. The second thing is a big if. If peacekeeping is needed, then of course China and other countries from global south are best positioned to play this role, because NATO countries, even if wearing the hat of EU countries, would not be trusted by Russia. Russia would simply take these countries as wolves in sheep's clothing, right? So otherwise, why would Russia have fought this war after all? It's because of NATO. The third thing is most obvious, given China's capability in infrastructure building that is next to none. China definitely can play a crucial role in post-war Ukraine, because China simply can do things more efficiently at lower cost.
It's interesting that you talk about this point about the potential for China to cooperate with countries from the global south and so on in terms of the potential sort of peacekeeping force when it comes to Europe. The other point here, of course, that's important is China has, the largest base of peacekeeping forces within the UN when we look at permanent UN security, the Security Commission there. But typically, China doesn't send troops in anywhere without authorization, and typically it hasn't played the role of this kind of security guarantor. So I wonder how you assess China's willingness to send peacekeeping forces into Ukraine.
Well, you see, for peacekeeping to happen, first of all, the warring parties have to have consent of the 5 permanent members of the UN Security Council. In this way, it is a bit different in that Russia, one of the warring parties, is a permanent member of the UN Security Council itself. So if peacekeeping is needed and has to be authorized by UN, this has to be a special arrangement. But because of China's contribution to peacekeeping that can be seen by everybody, and so I think China simply is better positioned to play this role, and because it can be trusted, and it is impartial, because impartiality is one of the preconditions for peacekeeping. But the significance maybe is that for the first time, China will be seen in having a role in the security of Europe. That is something unprecedented, but China is invited.
Right. Now, my question takes a step back, Senior Colonel. David here. You've been quick to emphasize that the role that China plays is post any ceasefire. Is there any role you think China can play that brings us closer to a ceasefire?
Well, I have some doubts about this. Yeah, that's a very good question, because right now Russia and the United States is having direct talks. So basically, I believe Ukraine should be invited to attend this talk. Otherwise, it look a bit like what Soviet and Germany did on the land of Poland, right? To have their own spheres of influence, because Ukraine is a country being invaded. So to let its destiny be divided by Russia and the United States, this is not so fair for Ukraine, I would say. But at this stage, I don't believe China can play a very big role. I believe China's role will come when they have negotiated something, but short of a guarantee. Then China can join other major powers in providing this kind of guarantee. And then China, of course, can do peacekeeping and post-war reconstruction. So China's role will come a little bit later.
There has been some discussion about the sort of so-called reverse Nixon possibility here, this idea that the US will move to split or at least create more distance between President Xi Jinping and President Vladimir Putin. How concerned do you think Beijing is about that possible scenario?
That is totally impossible. Just imagine for a moment, okay, in post-Putin area, we don't know when that will be, right? So a new president will normally change some of the policies by his predecessors. But given that China and Russia are largest neighbors towards each other, so whoever comes into Kremlin would have to consider about this fact that we are the largest neighbor toward each other. Therefore, we must have an amicable relationship. And I believe Russia's best chance of tilting toward the West was after its dissolution of the Soviet Union. Even Putin would want to join NATO. But if at that time that kind of dream was doomed, and given how good the relationship between China and Russia is, so I don't believe that even in the post-Putin area, this relationship will change a lot. And during President Putin's era, of course, I believe this relationship will simply continue.
Right. Can I just get your thoughts as well on, I mean, this takes us directly into Chinese-American relations, and we're trying to figure out where the rationale is amidst all the noise. And from your perspective in Beijing, has President Trump acted in a way that we were expecting him to act?
Well, this is an extremely interesting question. I believe that 1 month into office, he actually appeared quite friendly towards China, if we compare his attitude towards the rest of the world, right? So the question is, why is that? I believe he has learned some lesson from his first term. He should know that playing with his signature unpredictability would not work on a peer competitor. He would know that his tariff during his first term on Chinese products were eventually paid by American consumers. And he should know this time that China's dependency on the United States
Okay, I think we're just having some technical issues there with Zhou, who is, of course, our guest right now, joining us out of mainland China. He's senior fellow at the Tsinghua University Center for International Security and Strategy. We'll try and patch that back and see if we can get him back, of course, on the other side of this break. Speaking of, we're talking about geopolitics as well coming through here, and this week we'll have special coverage. And speaking of here, the arms race when it comes to drones. It's a competition really that involves the U.S., its allies, and also mainland China. And our tech reporter, Annabelle Jewellers, actually explains how drones are set to play an even bigger role when it comes to warfare. Have a look.
There's no question that drones have altered the dynamics of military operations. Unmanned aerial vehicles, or UAVs, have been in use for decades, including in the Cold War, Vietnam, and by the US to strike remote targets after 9/11. But on today's battlefields, it's different, not least because of the sheer volume of UAVs in the skies.
The current war in Ukraine is very much a drone war already.
The situation has been mirrored in the Middle East, with Hamas and Israeli forces deploying UAVs extensively. It's a signal of what's ahead, with the US spending hundreds of millions of dollars to secure new drones through its so-called replicator program.
If there's a major power war, it's very much going to be a drone war.
Technology is moving fast, particularly as artificial intelligence is integrated into UAVs.
Air superiority in a future conflict is not just going to be about fighter jets. It's going to be about drone swarms and loitering munitions and AI-powered targeting systems.
There's also a question of quantity, as military forces need to procure large numbers of less advanced drones. This has been a weak spot for the US and its allies.
US and many European states, they've actually for a long time been investing a lot more in the sort of more sophisticated long-range drones that have lots of sensors to them. It's really the mid and lower end stuff that they're trying to build up numbers, because as we've learned from the Russian-Ukraine conflict, the numbers do matter.
But China is the leader in commercial drone production, with its firm supplying around 80% of the global consumer UAV market. And Beijing has long seen these as a dual-use technology.
They've been real pioneers in cheap commercial drones, which can be adapted for military use.
It's clear that this is an area where China is putting intense capital, but also policy focus. I think the Chinese recognized quite early that drones could be the difference between victory and defeat.
Now Beijing's rivals are racing to catch up. Annabelle Drulers, Bloomberg News.
All right, we will have plenty more ahead here on The China Show. Keep it here. Welcome back. You're watching The China Show. We're back with retired senior colonel of China's People Liberation Army, Zhou. He's a current senior fellow at the Tsinghua University Center for International Security and Strategy. Apologies for some of the technical difficulties there, but I think we were just talking about relations. If you could just continue your thoughts, sir.
Well, you were asking whether Trump might just have a new attitude toward China. I think, this is sheer speculation, which I hope is not hallucination. I think it might be possible because after seeing how he has, acted in a different way against China. So I think there is a possibility that actually during his second term, China and American relationship might improve, contrary to most people's speculation. Because his legacy during his first term actually is a kind of a bipartisan, consensus against China. I don't mean he wants that himself, but he has largely left it to some China hawks like Peter Navarro and Secretary of State Pompeo to hijack this relationship. So who is the best position to change his own legacy? Of course, he himself, right? His attitude toward China so far has been friendly. So this gives me some hope. We'll see.
We also, nonetheless, still have seen this sort of flurry of actions taken by the Trump administration over the weekend, not least the shift on CFIUS, the change on U.S. investment, the pressure on Mexico to introduce its own tariffs on China. Do you think that all of these components of different pieces of news that we've had over the weekend, is this a step change in the response of the Trump administration towards Beijing?
As I said, we'll have to wait and see. But what is interesting for me is actually that his tariff on China is lower than the tariffs on Canada and Mexico, which is 25%, right? He only had 10% on China, and China, was swiftly retaliated with even 15% tariff on some selected American items. So because he talked about 60%, just imagine, when he was at the election. So this turned out to be much, much more, milder than expected. So that gives me a lot of speculations. I don't know where the future will go, but there is a hope that he could be different from his first term, and he could even be different from his predecessor. Actually, Joe Biden was quite friendly toward China. He was even called Beijing's Joe. But apparently he could not walk out of the trap laid down by those China hawks. So he even doubled down, on the road of competition with China to have this kind of a so-called small yard, high fence on and so forth. So we have some hope.
Do you think there's a chance we'll get a meeting between Xi Jinping and, dare I say, Beijing's Donald, just to use that analogy you just mentioned there?
Well, anything could happen because for China, this kind of direct talk among top leaders would be most, useful and significant. I'm aware of the remarks by Russian ambassador in China. He talked about how President, Xi has accepted Russia's invitation to go to Moscow to attend the commemorations of Soviet victory over Nazi. The Chinese media did not confirm that, but normally on such kind of things, Chinese media would only make an announcement a few days before such kind of things. But it's interesting, the Russian ambassador has mentioned it. The question is, $1 million question is, I believe Russia has also invited President Trump. So would Trump go there? If that happens, that would be really, really interesting.
There is a question in Washington, D.C. that some have been asking about whether or not a potential deal between Trump and Putin effectively gives President Xi a green light to invade Taiwan. Has anything really changed on Taiwan? Would any kind of deal between Trump and Putin change how Beijing thinks about Taiwan?
No, I don't think so, because people have been talking how Ukraine today will be Taiwan's tomorrow. But I think this is really, really a big issue. If you observe, you would find that the Chinese government is still talking about peaceful reunification, right? So yes, the fact is two leaders of Taiwan are DPP. But still, we're talking about the peaceful reunification. That means we still have lost the confidence. And why should we lose confidence? Because Taiwan would not move away. The strength of mainland is growing, both economically and militarily. So time is on our side. There's no such a hurry. We have never announced a timetable. That is the most important. We have never announced a timetable for peaceful reunification. So I believe we are still confident. A big question for China is, would the growth of strength of China make China more confident about peaceful reunification, or would it make mainland China more impatient to resort to use of force? I believe the answer is the first part. We're still having confidence.
Zhou, thank you so much for the time, sir. Senior fellow there at the Tsinghua University Center for International Security and Strategy. There's plenty more ahead here on the China Show and broader Bloomberg Television this Monday.
Good morning. You're watching The China Show. Researchers at the Wuhan Institute of Virology in China say they have discovered a new coronavirus in bats that enters cells using the same gateway as the virus that causes COVID-19. For more, let's bring in our China correspondent, Min Lo. Tell us, what do we know so far about this?
Yeah, so this is a new virus that is related to the coronavirus family that caused COVID-19 and also the Middle East respiratory syndrome, which had killed more than a third of the people it infected. It infected about 2,600 people up to middle of last year, mostly in Saudi Arabia. The good news is that the lab that identified this virus is saying that it attaches itself to the human body in a less efficient way as the virus that caused the COVID-19 pandemic. So the risk of this blowing up into a full-blown global pandemic at the same rate as COVID-19 is less likely. But still, it attaches itself to the human body by binding to a protein that's present in humans and other mammals. So there's the risk that it can jump from animals to humans directly or through an intermediate host. And that's why we are seeing these stocks of vaccine makers and diagnostic test makers across Korea jumping. And the stocks are trading quite mixed in China, though. And if the Institute of the Wuhan Institute of Virology, if that sounds familiar, it's because it's the center that has been really mired in that controversy over the origins of the COVID-19 pandemic. The U.S. accusing it of leaking that infection through an infected worker, but the claims are still contested because the U.S. doesn't have sufficient evidence to conclude that. The lab has denied that as well, but U.S. has halted funding for this particular institute since 2023.
Right, Min, thank you so much. Min Lo there on the latest in this. Suffice to say, we'll be tracking this one a lot more closely than many other things because of certainly events in the last few years or so. Right, a couple of other things as well. We'll skip this for now. Change the page, please, if we can. It declines right now. We're trying to figure out why, which is why I'm rushing through that as well. I'm not going to speculate on anything right now. Some of these agricultural stocks are limit up in mainland China on the back of these development guidelines to promote the sector. That's what you get, of course, when you get some policy support. Alibaba is out with a number confirming that earlier reports investing more than 50 will be investing more than $50 billion in AI and cloud over the next 3 years or so. And we'll leave you with a look at the Hang Seng Index this Monday. We'll see you all tomorrow. Have a good rest of your Monday.